Meredith mentioned, I'm a partner at SpringTide. We focus on health and life science technology, early stage investment. We're based in Salt Lake City and Boston. And we'll turn it over for a kind of brief introduction of our three panelists. And then we'd also like to make sure that we answer any questions that you have. So feel free during our conversation to raise your hand, and we'll hopefully have a great group of experts here to answer. So Branden, over to you.
Thanks. Branden Rosenhan. I did medical school here, practiced critical care, did a startup, and now MedMountain Ventures is a seed fund based in Utah and in San Francisco. And let's say we've been here doing this for about 7 years. So we're the smallest of these funds, but we're the best.
It's true. It's true. I'm Jack Boren. I'm one of the co-founders of University of Utah Ventures, which is managed by Epic Ventures, where I'm a managing partner. Epic's been around for about 30 years, a little over. We're on 10 funds. And we were originally founded as kind of one of the early groups looking at startup ecosystems outside of the Bay Area. We've evolved pretty substantially since then, but deep roots in investing in kind of non-traditional ecosystems. Health and life sciences is a big part of what we do. We are a generalist fund, but it's a little over half. And 2 years ago, we partnered with the University of Utah to launch University of Utah Ventures and become the strategic venture arm of the university. And that is a public-private partnership between us and them and various other constituents here locally, groups like ARUP, Utah State, Zions Bank, really aimed at doing three things. You'll see us doing three things. The first is supporting the spin-out ecosystem of the university and co-creating with them, so starting our own companies. The second is investing around the, call it affiliate network, which can be regional startups, it can be vendors, partners, co-development partners, let's say, alumni, founded businesses. And the third is we act as a landing pad for innovation into the state of Utah. So we kind of invest in other random stuff outside of the state, and we invite them to come in here and innovate with our universities. So excited to be here. Ryan, thanks for inviting me, and glad to chat with all of you.
Yeah, Luke Larsen. I'm a vice president with Wasatch Health. If you're familiar with the Wasatch Group, which usually you think of real estate when you think of the Wasatch Group, but we have a pretty big portfolio of healthcare companies. It's the second largest portion of the Wasatch Group now, and Wasatch Health oversees all of those investments. It's primarily in medtech, pharma, and then the supply chain and infrastructure behind medtech and pharma. We were actually founded as MedVenture Health. I know Branden was happy when we changed our name because our names were so similar to each other for a while there.
After a rude lawsuit, right?
Yeah, that's right.
We lost.
No, but we rebranded as Wasatch Health last year just to fit the full brand, and kind of brought a few different entities under one roof and managing all the healthcare pieces of the Wasatch Group now.
Great. How many in this room are founders okay. Great. Okay, so that's going to be our primary audience for these questions, and then we'll ask some other questions as well. So, raising money in Utah as a life science company, how many are looking for their seed round? How many are looking for your Series A round? How many are looking for your Series B or above? Okay, so for the primary group of seed companies looking for seed rounds, what would be your advice to raising money as a startup in Utah? I'm going to start with you, Luke, at the end.
Yeah, I'm probably the worst person to answer this because we don't invest that early very often. But the way that I always think of it, when you're raising a seed round or pre-seed even, it's really all about vision, right? That's what most of these investors are focused on. What is your vision? How are you going to carry out that vision? But it's really critical that you think through the whole life cycle of the business. We see when we get to our stage, we're kind of late stage venture growth equity investors is typically where we get involved, so Series B and beyond. But you kind of see this transition where you need to see a company grow and they need to have the vision from the very beginning of what the vision of the company is, who and what the team needs to look like to achieve that vision. Technology for most of you in life sciences is what you think of first, right? You always have some kind of technology, but and usually it's well thought out. A lot of you are engineers or physicians. But then when it kind of gets to us, it's much more about execution, execution, execution. That's what we invest in. And so this part is not unique to Utah, but you need to have that whole roadmap planned out from the beginning. While they may focus more on vision earlier on, it's important that you're thinking all the way through the end and how you reach each of those milestones to continue to get the funding to bring your product or your device or whatever it might be to market. In Utah, I would say the environment is getting much, much better. There was not a lot of investors anywhere in really any market. Kind of had the tech boom first, that brought in some investors, but it's actually quite astonishing every year how many more life science investor groups I see pop up in Utah. So I think that's getting more and more appealing. I'm also constantly seeing people from Boston, San Francisco spend more and more time here in Utah. We get a lot of connections from other firms that really, really desperately want to invest in Utah and are looking for the right connections to do that. So I think there's a lot of opportunity here for all of you with firms in Utah and the more traditional coastal city funds.
Maybe I'll go next, and Branden, you can bring it home. You do a lot in the seed stage. For me, I'd say know your audience and cast a wide net. What I mean by that is, first and foremost, you should talk to as many investors as you possibly can at that stage. When you look at actual hit rates in terms of how many you talk to versus how many invest, it's astronomical. It's like 100 to 1 in the seed stage. So you're out there getting 50 no's in a row, you're in great company. It's a dismal company, but it's great company. It's very common. So talk to as many as you possibly can, and understand who your audience is. Even if they're just not the right investor for you, ask advice, ask whom they know, how they would approach your fundraise process. Utah's unique in that there's hundreds of millions, there's billions now at this point in capital ready to be deployed in early stage venture capital investing. Most of that capital does not know how to assess the health and life sciences markets. It doesn't mean they don't invest in them. They actually do quite rigorously, but they don't know how to approach them. So be really thoughtful about how you pitch to those investors, meet them on their level. When you come into me, for example, and you want to talk about whatever new novel therapeutic you have coming, understand that I don't know what the hell you're talking about in your specific world. So please dumb it down. I really do get excited about things, but I need some help getting there in the first place, and the Utah market's no different. The last thing I would say is warm introductions are king here. Don't just reach out cold. Look for people in our portfolio. Look for our advisors. We post all this on our website. I'm sure everybody here does. And find co-founders, find venture partners, advisors, LPs, whatever we mention, and try and get a warm introduction from one of those individuals. The really unique thing about Utah is that people want to share insights. They want to help each other. It's a collaborative type community. So when you call up somebody like, for example, Mason Victors, who's one of our venture partners, he's the former CTO of Recursion Pharmaceuticals. Mason will be delighted to talk to you about your business, give you advice, help you think through what a fundraise strategy might look like, who you might want to partner with, et cetera, and often those lead to introductions to people like us. So anytime Mason introduces me to anybody, I'm going to take that call. And that's it's a really great way to get a warm landing pad for your business at our firm or anyone else's.
Yeah, I do better when I'm on these panels because of a medical issue a long time ago if I tell a little story. So when I was here in 2012, I was a physician. I was a fellow and wanted to raise capital for my first fund, or for my first company, and it was really, really hard. So Jack nailed it in that you got to put a wide cast out. You got to cast out a wide net, and you got to go get money from anyone you can, because money will help you get some traction, and traction will help you get the momentum that we're looking for, even at seed. And so, you have to just go hard and go wide, and then you want the warm introduction. So I can't say anything more articulate. I will take any meetings if it's a warm intro, and I will look at any deck, because that's how we succeed, is being a seed fund. And we do anything that's in medical devices, digital health, health IT. We don't do a lot of therapeutics, but we really do look at anything. And my partners, who are physicians that are much smarter and still practice, they're even better than I am, and they're even nicer than I am. So, Jack nailed it in that you got to go wide. You got to leverage your relationships. These things are good. We have I think Andy's here, and we met Andy 6 years ago, and we were their first investor. So things like these can be frustrating because you leave, and I couldn't even talk with so-and-so, or they seem to, you just got to keep going.
Yeah, one of the benefits of being a more consolidated, smaller ecosystem is that there's a lot of opportunity to meet people in these forums, and so I know BioHive, BioUtah, Altitude Labs, the Nucleus Fund, all great things to be able to kind of convene people and technology. I wanted to pause here and see if there are any questions in the audience from our prospective seed founders. All right.
Just going to double click one thing on Jack said, and I apologize, but you do know the audience. You got to know the audience. I'm going to a conference next week, and I have an email full of 200 invites for their app there, dude. Literally 200 or more. And most of the people are like pitching me for Series A. They don't even read my bio. They don't even read about our fund, and I have now capitalized SEED capital, and they still ignore it. So you got to really know what we're looking for. Websites usually use it, and then when you have warm intros, you usually also have the information. So we'll look at anything, but don't come to me with like a big Series A or a Series B round.
And AI is a great thing. It is not helpful for personal communication. We all, like, you can see through it. Any email that has bold, certain like cadence, like you all can see it. So that's definitely a screener. Yes. All right, I'm gonna actually have no, I could, but I'm actually gonna have you talk about seed and the difference between seed and pre-seed, and then if you can talk about the difference between seed and Series A, and then you talk about B and beyond, and maybe that cadence, just because there's different thresholds of what you look at those lines of demarcation and so on.
Short version is seed is even going later. So I would say you go get money from nearby, from physicians, from scientists, from people you can. That's smart money. Then you go to angels, and you can get at least some other money. Or you can come to us. And seed means anything, and it depends on the digital health, the health IT, or the medical devices. There's not a great way to say this because it's a bit like we will write the first check on somebody when they don't have any capital in, but we also will wait for someone to say, like, you need $1 million to where you are. We want to see a real pathway to, you don't have to be commercialized. You don't have to already have revenue, but we're actually kind of moving more towards that as a seed. So yeah, it's not clear, but it's clear that we don't do rounds where they're $10 million like rounds. We don't do rounds that are like $5 million rounds. We do rounds that are like $1 to $2 million rounds. They can evolve depending on the market. If it's medical device, $2 million. If you're going into digital health and health IT and it's still seed, it could be a $5 million round, but above that, we're not looking at it.
You know, we're a little unique in that we are a multi-stage fund. We call ourselves traditional early stage venture, which 30 years ago meant you did anything that was kind of pre-growth. You did pre-seed, you did de novo stuff, you did A's, you did B's. Now they're all chopped up into all sorts of different things. But the way I think about it, like when it's an idea, it's maybe pre-product market fit or barely product market fit. You probably sit in seed, and you might be raising sub $5 million. Although seed rounds are getting wild these days. Above that, you're probably in the A category if you've got a little bit of early market traction. And market traction can mean a couple of different things, especially in the health and life sciences space. You could actually instead say you might be a little further down the drug discovery development timeline. You might be filing for an IND. You might be kind of raising for your phase 1. But you're raising more like 5 to 20, somewhere in the A range these days. And anything above that, you're probably a B. And frankly, 20 is probably on the edge of that anyway. For us, we really do try to back into, is there any validation that we can value, either today or 12 to 24 months in the future? And how does our position change from today to the next time that you need to raise capital? At the end of the day, we are financial sponsors. Even a group like ours, right, where we're strategically aligned with the university and all of its interests, that's actually just a benefit for us. At the end of the day, we are greedy capitalists. And we need to show our LPs that the investments that we make were awesome decisions and that they're growing really quickly and everybody else thinks they're awesome too, so that we can raise more funds in the future and do it all over again. We're in the same cycle as you guys are. Every 3 years, we're raising a new fund, and in those interim years, we're deploying it, and we're trying to convince our investors that we aren't idiots. So we need to see progress, and we need to see progression, and we price our rounds with the next round in mind, to say you're going to raise again in 12 to 18 months typically, and we need to see a meaningful step up in our holding in that time period. And frankly, it's typically 2 to 3x where we've been holding it at. And otherwise, it's not personal against you and your deal. You can probably go find better, cheaper capital elsewhere. But that gets back to the know your audience thing. Know our business model as well. And our business model is high momentum, high velocity, and we need to show results. And that means that we're going to price it based on how much you're raising, and i.e. how much we can own, and what you're going to be worth the next time you raise. And so we're kind of backing into those two things. And the last thing I'll mention is that, I don't know how to say this anyway other than just coming out and saying it. We kind of suck at our jobs. Like if you look at actual venture returns across the ecosystem, like mean is like, I don't remember exactly what it is, but it's like 19 or 20%, IRRs. So you're earning 19 to 20% for your investors on an annual basis. Median is like 7. So what we're trying to get into here is a lot of VCs don't choose very well, and our business model is built on having 1 or 2 exceptional deals in our portfolio that pay us and our fund and all of our investors back a ton of money, and a lot of goose eggs in there. So every deal that we do needs to have the either just amazing certainty, which is rare in our ecosystem, or it has to have the potential to be big enough to pay for all of our really stupid deals as well. So know all those things about us, and that really factors into our pricing. There aren't hard and fast rules. It's early stage venture, but all things to consider.
Yeah, really good descriptions up to this point. So we invest generally in Series B and beyond, and ours is really easy to quantify because we want the business meaningfully de-risked, which means we want you to have regulatory approval. We want you to have some commercial traction. We're earlier than a lot of other growth investors. We'll do it if you have $2-3 million in revenue. A lot of growth investors wait till 10, 20. So we're earlier than most, but really what we're looking for is clinical data, de-risked. Regulatory approval, de-risked. And then really what we're investing in and where we think we add value as investors is in the operational efficiencies and execution ability of the team that we bring in from an operating partner perspective and the capital that we put behind it in building infrastructure and the capacity that's required to really scale a business.
Hey, great. So the long story short is nomenclature is not certain and exact. And oftentimes, if you do a seed round and the next person, you get another seed round investor, you could rename the previous round a pre-seed round. So there's nomenclature really is aside, but I think there's really good articulation around some of the theory around what nomenclature for different rounds. Is that helpful? Great. Any other questions? Yes. This is a great question. And so I actually want to add a little bit to that. What are the guidance that you would say about taking on family office money, and how does it fit in to the overall fundraising cycle? Do any of you want to take that one?
I'm happy to start because Wasatch is a unique situation where we, in some ways, operate a little bit like a family office. We do have traditional funds, but a lot of our capital that we invest is a multifamily office fund. And they are really hard to get a hold of. You're right, warm introductions is the right answer. But I'll say that for venture, it's pretty rare that family offices, unless they're involved in like the angel type, and those usually aren't even family offices. Those are just high net worth, maybe very high net worth individuals. When they start getting ultra high net worth, then they have family offices. And there's some that have venture strategies, but a lot of them are later stage. And getting access to them really is about identifying first who they are, and then just looking for people in your network or website. I think kind of scraping websites is the right thing to do to see if you know any of the companies that are involved with them. Family offices are especially sensitive to warm introductions, I think, compared to other places. And if you can they're really relationship focused. That's where a lot of our family office investments come through, is if you can get to the right person within the firm, you at least have a pretty good chance of getting a couple meetings. And so, really working your way into the right relationships. And even if it's like a second or third order relationship, it's still worth the time and effort to get that.
The one thing I'd add as well is typically I would say, like, it's a hard crowd to really navigate and use as your primary funding strategy. That being said, healthcare, life sciences, et cetera, are very unique in that there are many large donors to various causes that for some reason that, a family is, one of the donors is afflicted by, So for example, I have an investment in a company called Unlearn AI, and it's foundational model in the clinical trial space. And some of our early funding was brought on by groups that were just particularly interested in the Huntington space. And there are families that are really afflicted by that terrible disease that have been successful elsewhere and would like to support, causes that are trying to help out that space in some way, shape, or form. And they look at it as both an opportunity to donate and an opportunity to support companies in the space. And those can be unique investors, like very low touch, very supportive, want to introduce you to the funds they're invested in, et cetera. Again, in the health and life sciences space, you could just be deliberate about looking at advocacy groups, support groups, et cetera, who's funding what, and targeting those offices specifically, as long as it matches up with the mission that you're targeting.
I just want to make a point to, I think family offices really rely on institutional investors to do due diligence. So oftentimes, especially in later rounds, I think earlier on, they're willing to take more of like investing on a note or some other thing where there's not necessarily the rigor and the structure around a priced round. And I think that it's important to have that as a dynamic that sometimes putting on that requirement on them to be able to do that is difficult. I would also just say that if you are a venture-backed company, and meaning that you have the returns that Jack was talking about, that's your objective. I think that there is a lot of value in having an institutional lead that helps your credibility and helps you grow, because those family offices can be an early sign of support and but not necessarily lead on future rounds. So I just think that's something to be cautious of as you're having those conversations. I don't know if anybody else has any other thoughts.
I'll just make one addition to that. I think at the end of the day, what matters most is that you get the capital, and it matters very little where it comes from, as long as you don't impose onerous terms on yourself that will restrict how you do business in the future. Family offices, some have dramatically institutionalized and are becoming more sophisticated, but it's not uncommon for us to look at deals that have raised capital from family offices at just weird terms. And it's not necessarily like nefarious, it's just people that don't do this. When you're working with dedicated funds, we do 15 deals a year, and we see a lot. We assess a couple hundred, we seriously assess a couple hundred every year. So we see a lot of frameworks, we see a lot of structures, we work with lawyers that structure these deals, et cetera. And you just don't want to introduce like hair onto your deal early on. At the end of the day, we're all looking we see so much volume of deals that we're kind of just looking for reasons to say no on deals. And structure is often one of those things that can disqualify something from our process. So again, I'm not quite in the camp of even frankly believing that institutional investors bring all that much value unless there's some alignment with a strategic. But not to denigrate myself and my industry, but I do see the value in being choosy about institutional investors because they're going to give you a deal that looks more boilerplate.
Yeah, thanks, Jack. Any other questions? Yeah.
Many have said that it's the most interesting, impactful, and important thing you can do as a fund is to align yourself with a university, many being mostly myself.
On that question, and one of the things that we try to do is have relationships with PIs and technology throughout the country. And I think that's when you think about our health systems and our academic world, they are our most innovative places from a technology and science perspective. They are also the most difficult places to apply those innovations. And so I think that there is an important place to be able to identify technologies, and especially when you have the non-dilutive grants, and there's a lot of mechanisms to help nurture those concepts and ideas, and it's a really wonderful, productive place. So I think there is a lot of value that you can leverage from that perspective. There was another question back there. Yeah.
Awesome question. So we do three things. The first being things that come out of the university. Some of those are spin-outs, in the traditional sense. Some of those we co-create with the university. The second is we invest around the affiliate network of the university, which for us is regional startups, Utah startups, let's say, or anyone with a tie to the university. That can be vendors, partners, et cetera. And then the third is we invest throughout the United States in what we consider to be best-in-class innovative businesses, and we hope to attract those into our ecosystem. We deliberately went out and sought a partner like the University of Utah with our last fund as a way to provide a different level of value to our founders. The university is a spectacular partner to the innovation community. They have a variety of resources they can bring to bear to support companies in their ecosystem. And that can be anything from like dedicated core labs pricing, et cetera, for, helping you validate your whatever you're working on, to providing office space, hiring, helping you think through technical problems. They can be a great customer, validator. The university owns the third largest reference lab in the US, ARUP, which can be great for supporting your business as well. We deliberately sought out somebody that could provide unique benefit to our ecosystem, such that when you take capital from University of Utah Ventures, you get to work with me, and I understand the finance side of it quite a lot, but I get to plug you into really interesting people at the university that can support you on the scientific side as well. So, yeah, that's to say, that's a long way of me saying we do those three things. It's not just for spin-outs, it's not just for Utah, except for in the fact that everything we do, we want to plug into our ecosystem here in Utah to support both them and to elevate, the economic output of the region.
Great. There's another question back there. They're great. Branden, you want to take that one?
Geez, we don't have that much time. I think getting a early stage CEO, when I say early, someone a few years ahead of you, that can give you the feedback, because everyone views decks differently, like how your presentation is. Everybody views the way that they think about the market and how they think about distribution. We think a lot about distribution on medical device stuff because I've done one myself, and it's hard to get those things into the hospitals or in the clinics. And so if you don't have like Jack said, at the end of the day, we're investors. We're actually so early money managers, right? So our investors trust us to make the best investments, and they want money returned. So we have to have the companies that are going to grow and generate revenue. So really, to me, if I had to say one thing, it's when they haven't identified how they're really going to make money. It doesn't matter how early it is.
Just kind of second that. All the time I see devices or ideas that are cool, but they don't actually solve a problem in a market that's meaningful enough. And you see, really, especially early stage companies just flounder with, well, I have this really cool technology and I'm just trying to find the solution for it. If you come with that to investors, it's just, yeah, how are you, ultimately we're asking you, how are you going to make money with this technology? And it has to be a really clear story with a really clear market. And kind of like I said at the beginning, thought all the way through from beginning to end on how I'm going to get the team I'm going to build, how I'm going to execute, and how all of these things are going to work together to ultimately create value.
And I mean, our firm, we're physicians and we still believe in Hippocratic oath, right? But the system, the hospitals have to make money. Even like Intermountain, it's nonprofit, they have to make money. And so again, you have to have, people can love what you're doing. They can think it's going to change patient care, but if there's no money that will pay for that patient care that's going to improve, it won't happen.
Any other questions? Great. Well, Meredith, thank you for hosting us. And I just want to say I have such high respect for our panel today. And we talk about VC in Utah. We're just grateful to have organizations like these with us, and also our community, Kelvin and Bio Utah, and all the resources. These are just tremendous. Collaboration really is our superpower in the state of Utah, and I think that let's take advantage of that. As you have successes, make sure that you're mentoring others along the way, and I think that really is kind of the glue, as Jack mentioned. It's warm intros. It's the community that's really what drives venture capital. Really is that collaboration. So thank you for being here, and thanks for our panelists.